What's up, everybody? Welcome to Heresy Financial. This is the show where we talk about financial education, advice, and topics and guidance in a way that is considered heresy to the financial establishment. Today, we're going to be talking about the number one key to investing successfully with low volatility and avoiding large losses. That key is diversification. And spoiler alert, it's not what you've been told. Let's dive in. All right, guys, today we're discussing diversification and what diversification really is and what it means. And this is probably the most important thing to understand in order to invest successfully. Let's look at a hypothetical account. Let's say in your retirement account, you have 5 mutual funds. And let's say you're an educated investor. So you went in there and you looked at the top performers of all of the available mutual funds in your work-sponsored retirement account for the last 5 to 10 years. What you're going to find is the top performing mutual funds are going to be things called growth funds or large cap funds or domestic total stock market funds. So you'll probably pick about 5 of those and you'll say, hey, these were the best performing over the last 5 to 10 years, so I want to put my money in those. And you've got 5 to 10 different mutual funds, and each mutual fund contains anywhere from 50 to 500 different companies inside that mutual fund. So most people would say you are fairly well diversified. Would you agree? Well, sorry to burst your bubble, but you are not diversified. Because if you take a look at each one of those funds, you can dive into the details and look at the top 10 holdings in each one of those mutual funds. And I'd be willing to put money on a bet that says the top 10 holdings for every single one of those mutual funds is exactly the same. You've chosen mutual funds that are all invested pretty much identical to each other. But that's not the worst part. Let's say you just choose one of these mutual funds, since there's really no difference between putting all your money in one of these mutual funds or splitting your money up between 5 or 10 of these mutual funds, since they're all invested in the same companies anyway. If you have one mutual fund that has 500 or 1,000 companies inside of it, most people would still think that you are fairly well diversified because essentially your money is split up between 500 or 1,000 different companies. So even then, do you have diversification? Again, the answer is no. And there's one word that explains why you're not diversified in that situation: correlation. See, correlation is the key to achieving diversification, or I should say, not having correlation is the key to making sure you do have diversification. Correlation means that if this investment goes up, this investment will stay the same or go down, and vice versa. If this investment goes down, this investment will go up or stay the same. And so if you have low correlation, that means things that happen in the market will affect your investments differently. If you have high correlation, that means something happening in the market will affect all of your different investments the exact same way. They'll all kind of go up together and they'll all kind of go down together. Now, the vast majority of mutual funds out there, especially the top performers over the last 5 to 10 years, and especially the ones that are available inside of retirement accounts, are all invested in stocks with extremely high correlations. And the reason is because most of these funds are all invested in the exact same stocks. The top 10 holdings of all of these mutual funds you're going to find are things like Amazon, McDonald's, Apple, Microsoft, Facebook. They're all the large cap stocks that are the biggest in the market. And even the mutual funds that are invested in 500 to 1,000 companies are usually invested primarily in the S&P 500 and then maybe some mid-cap stocks on top of that. And again, you need to understand that the vast majority of money invested in equities out there is distributed among all of the same companies the same exact way. So what's the problem with this? The problem is that whenever there's something good that happens in the market or bad that happens in the market, the same exact stocks get bought or sold. The institutions and the algorithms that are driving the market based on news, based on data that comes out, based on trade war announcements, based on whatever happens economically, the same exact 500 to 1,000 companies are the ones that are spread out between almost every single popular mutual fund out there. And so when Trump tweets, when new jobs data comes out, when Saudi Arabia gets attacked, when the Hong Kong protests fire up again, when the Fed cuts interest rates, all of these news announcements do the exact same thing. They'll either cause buying in the stock market or selling in the stock market. And all the institutions and algorithms that are doing the buying and selling are buying and selling the exact same 500 to 1,000 companies. So while you might look at a company like Amazon and say that it has nothing to do with McDonald's, they're in entirely different industries. One is e-commerce, one is food. You might look at them and think these are entirely different industries, so they have nothing to do with each other. The problem is both of these companies are going to be bought and sold at the exact same time by the exact same institutions based on the exact same news, whether it affects that business or not. And so we have a problem with correlation, because these companies out there that seem like they should not have correlated performance actually do. And so the number one key to investing your portfolio appropriately so that you do not have these massive wild swings up and down, this high volatility and exposure to massive market drops, is achieving low correlation between your assets. Because if you have multiple assets that all have high correlation, you don't actually have diversification. Just because the companies inside the funds are in different fields or industries or sectors doesn't mean their performance is going to be different. Their performance, especially short-term, is going to be driven large in part by the algorithms and the institutions that are buying and selling based on the news. And so if you want a rock-solid portfolio, you need each one of your investment choices to have low correlation to each other. That way, if one piece of news comes out, your entire portfolio doesn't react together. Each portion reacts differently. I'll give you an example. If you have US dollars, cash, as a portion of your account, that is going to react almost inversely to gold. Those are two very low correlated assets. And so if the dollar becomes worth more, you'll likely see gold become worth less. And vice versa, when the dollar becomes worth less, you'll likely see gold become worth more. Another example is foreign stocks, and especially emerging market stocks. They're going to have relatively low correlation to large cap US companies, because in times of economic turbulence or in times of economic growth and prosperity, you're going to see money flowing one way or the other. Two other areas that have low correlation might be bonds and real estate investment trusts, or REITs, R-E-I-T-S, because interest rates are going to drive the two. Now, there are multiple types of REITs, so you'll want to make sure that you are looking at what type of REIT it is, but interest rates will drive those separately. Now, I've spoken previously about how I do think bonds are probably some of the riskiest assets out there right now. But I am just showing you that there are different ways to construct your portfolio to achieve real diversification by looking at correlation. Now, that doesn't mean you can't make money by having high correlation. Let's be honest, if you would have put all of your money in Amazon 20 years ago, you would have had no diversification and 100% correlation because all your money is in one stock. And you would have made tons of money. But you could have just as easily put that into pets.com and watched your money become worthless. So that's where low correlation and real diversification comes in. It's to eliminate massive losses. Because if in one portion of your account you have massive losses in a low correlation account, that should mean that the rest of your account compensates for it and makes up for it. Now, there is one more way to protect your account, and that's using options. If you have an account that you are approved for trading options on, you can use options in order to purchase puts, which is kind of like buying protection or an insurance plan on your account. If you'd like to learn more about how to do that, I will put a link to my options training course in the description below. Thank you so much for watching. I really appreciate it. If you like the information, please like and subscribe and share with somebody that you think would enjoy it as well. Help a small channel out. You guys have a great day.